It didn't take long for the ripples from China's Black Monday market collapse to make their way across the Pacific. The ticker board in Toronto this morning was filled with red, leaving the Canadian business world anxious. By midday, the TSX had rebounded, and entrepreneur Victor Ng, who streamlines cloud technology for Canadian companies interested in expanding overseas, was once again touting China for its possibilities.
Even though there is a little bit shaky in the stock market right now, but it doesn't mean that the fundamental economy of China has any impact over there.
Shaky, considering the morning roller coaster ride, is a generous term. In Canada, the tremors started with commodities. Oil has now dipped below $40 a barrel, unheard of territory a decade ago. And it's acting like an anchor for the loonie, dragging it to a 10-year low, around 75 cents to the US dollar. And all of this matters because it could push the Bank of Canada to lower interest rates in September. It sounds bad, but economists say Canada's economy can withstand the turbulence.
With a floating exchange rate, it cushions and absorbs some of the shock from the decline in the price of oil. It doesn't eliminate the shock. It just makes that very bumpy ride a little less painful, a little less bumpy.
Now, how this all plays out for Canada depends largely on China's short and long-term prognosis. Canada, like many other commodity-rich countries, relies on exports to Chinese manufacturers. Has China's bubble burst? Will it need less oil, less iron?
The best advice is to fasten your seatbelt and to leave it on. Don't leave your seat because you may get thrown around.
Translation for the average investor, don't panic, at least not in the short term. Mike Drolet, Global News, Toronto.